Hi, today we're going to talk about income splitting for the owners of Canadian-controlled private corporations. The owners of Canadian-controlled private corporations actually receive two gifts in the Tax Act from CRA. The first is what we call the tax-deferred advantage. These are the low corporate tax rates versus high personal tax rates. The second gift is the ability to income split to legal shareholders and thereby lower the tax cost to the total family for cash flow required on an annual basis. The tax-deferred advantage is a 25 to 35% difference between the small business tax rates for a Canadian-controlled private corporation and the tax rates normally paid by individuals when they receive income out of those corporations. So while those funds are left inside that corporation, it becomes this interest-free loan from CRA while those dollars are being invested in that corporation. From that pool of investment money, we can create certain types of income and or withdraw capital from those and pay them out to the shareholders using these income splitting strategies that we'll discuss in a moment to thereby lower the tax required by that family on the annual basis. Lawyers and accountants for Canadian-controlled private corporations tend to ensure that a separate class of preference stock is created for each individual family member. For example, A for dad, B for mom, etc. These shares are usually non-voting, have a nominal value, and are retractable at the pleasure of the board of directors, which are usually mom and dad. Allocations of certain types and amounts of income may be allocated to each individual at year-end using these shares, provided that those people are legally entitled to that income, that they are not subject to attribution, that is, and they eventually get the use of the funds represented by that income allocation. The types of allocations may be non-eligible dividends, eligible dividends, and or capital dividend amounts, which we'll describe in a few moments. Shareholders must have had legal possession of their shares while the profits and assets were created in the Canadian-controlled private corporation to avoid attribution. So, some examples of income splitting and how they're used in everyday practice. Often one of the shareholders of the corporation is a dependent adult child going to university. Normally the parents end up paying for this out of their own personal after-tax dollars, but this income splitting process will allow the board of directors to allocate that individual enough dividend flow to pay for their room and board and their tuition at university. The tuition deductions, the education deductions, and the dividend tax credits more than offset the taxes otherwise payable on those dividends for that individual. Another example that's used every day is what I call the grandparent allocation. If we're going to support our grandparents in old age, we normally have to do that with after-tax dollars. But if they're shareholders of this Canadian-controlled private corporation, which is perfectly legal, we could allocate the income to them in the amounts required to support them and have the family pay much less tax on that allocation. Another example would be the sabbatical. If an individual, a shareholder of the corporation, desired to take time off and not work, then an eligible or even a non-eligible dividend flow could be paid out to that person while they are earning no other income. And they could essentially earn those at a very low rate of tax. In most provinces in this country, that could be upwards of $48,000 in 2013 without them paying any taxes at all. The last example would be someone, a shareholder, already in the highest marginal bracket. If that individual required cash flow for whatever reason, we could allocate them a dividend out of the capital dividend account at the end of the year if the balance existed there. These balances are represented by the net capital gain, at least the tax-free half of capital gains realized during that year in the investment portfolio held inside that corporation because of the tax-deferred advantage. So how can NexGen help? Well, our corporate class mutual fund structure turns every investment decision into two, not one decisions. You can select our funds that most closely meets your risk tolerance, and then select the tax class which represents your tax objective for the year. For example, one of our classes is our Dividend Tax Credit Class, which pays out a monthly flow of eligible Canadian dividends on a per share monthly basis. So with NexGen, you get to control your risk tolerance and your tax cost and get both at the same time. Hope you found that useful, and we'll see you the next time.